Welcome, everyone. This is our fourth quarter report, actually going into 2023. I might even call it our first quarter of 2023. The purpose of this video is take a look at what happened in 2022 and what we see going forward in 2023. So as you all know, my name is Michael Reese. I'm sitting here today with Jeremy Aston, one of our newer members on the team. Jeremy, you spent some time over at TRS as one of the portfolio managers, weren't you?
Yeah, that's correct. I spent 12 and a half years over there at TRS working on a variety of different equity portfolios.
Yeah, something like, what were you telling me? They have like 200 billion under management or something like that?
Roughly 200 billion. That's correct.
So you were helping with that. That's more money than we manage, but that's we're working on it. So anyway, Jeremy's going to help me walk along this quarter's report, and at the end, we're also going to share an update on how we're setting our portfolios up, your portfolios, if we're helping you with your money as we enter into 2023. So I'm going to go ahead. I'm going to share my screen. We have a bit of a presentation put together. Jeremy has been nice enough to put together a bunch of charts for us. So let's go ahead and get this baby rolling. Whoops, that's not my screen, is it? Try again. If at first you don't succeed, right? There we go. Real quickly before we dive in, Jeremy, what we have to do every time we do this is we have to share a disclaimer. These are so important. For those of you who would like a copy of the disclaimer, we're happy to send it to you. And essentially, this is just a bunch of information that is, we're telling you past performance, no guarantee of future results, etc. So, Jeremy, we're looking at the year last year, and I'm looking at all these returns. I'm not really seeing any excitement here except at the bottom. Are you?
No, not at all. 2022 was definitely a difficult year for all the different asset classes. It was quite an odd year. In fact, it was the first time in about 40 to 50 years that both equities and bonds were down in the same year. So it was a pretty odd combination of results.
Yeah, I'm looking at this and I'm seeing like the large company in the US down 18%. I don't know how the Dow was only down 8, probably because there's a lot of value in there, like a lot of dividend paying stocks.
A little more defensiveness, yes.
Yeah, I'm guessing NASDAQ got crushed, 33. International lost money, emerging lost money. Look at real estate. Whoa, that thing got crushed. Probably interest rates, rising interest rates probably impacted that,
Absolutely.
don't you think?
Absolutely. That and concerns over the commercial real estate market. And what are we going to do with all these office buildings going forward?
That's right. Because so many people are working, was it remotely, right?
Absolutely.
And then you've got fixed income. Even that's what you're saying. You're saying bonds, like, I think, what was it, like 1970, the last time both the market and bonds were down at the same time? It's like 52 years.
That's correct. It was roughly about the same time that we had the same sort of inflationary pressures building up in the economy, that this sort of thing happened with bonds going down at the same time as equities. As interest rates are rising, it puts downward pressure on the bond market.
Yeah. So meanwhile, I'm sorry, go ahead.
No, it just creates difficulties for both equities and fixed income at the same time. So it creates a very difficult market to navigate.
Yeah. Meanwhile, commodities made money. So basically, turns out we should have put all of our money in oil and wheat and corn last year.
That's right. Real assets.
Yeah, the real stuff. All right. So let's go ahead and let's take a look. You've put together a number of economic data for us to review. We have GDP. So what are we looking at here?
Right. Just looking at this slightly longer term trend of US GDP, it's looking at roughly the past 10 years. You can see that we had a dip down in 2020 during COVID, but we have roughly come back to the trend line. So
yeah, in fact, I think that's our next slide. That's our next slide here, right? The trend line.
Exactly. You can see this 2% trend line from the beginning of this century going forward. We're basically right on trend. And then the right-hand portion of this chart, you can see the components of what make up GDP. You oftentimes hear that we are a consumer-led market, and that is absolutely true. You can see that a little bit more than 2/3 of our GDP comes from consumption, so 68% overall. So where the U.S. consumer goes, that's where the U.S. GDP trend is likely to go as well.
Okay, so one of the things that this might represent a bit of a headwind, right? Because I think I've been seeing quite a bit on CNBC. I look at it every morning, I have to admit. Not the TV show, but the website. Anyway, I've
Right.
noticed a lot of reports coming out where consumers are starting to be more frugal with their spending next year as we go into 2023 rather. And if that happens, if the spending goes down, how's that going to affect GDP?
Right. It could put a limiting factor on GDP growth going forward. The consumers are kind of at the point with the inflationary pressures that we've seen over the past couple of years that their pocketbooks are getting stretched at this point. And, you know, with the price of groceries and gas and everything else like that, rents going up, the US consumer is kind of at the point where they're having to make some choices in their pocketbook spending. So it is not at all for sure that the US GDP is going to grow in 2023.
Yeah, in fact, I think the definition of recession is when GDP goes down for, what is it, 2 quarters in a row, I think, right?
That's correct.
And
Yes.
so if they spend less money and they drive GDP down, I mean, there's a lot of economists that are concerned about recession next year, and that's a big part of it is that big blue box there on the right is consumer spending. As we move forward, we also have some unemployment data in here, right?
Yeah, this is one of the bright signs of the economy, is that the U.S. unemployment rate has been hovering around historic lows, actually. So you've got people that are fully employed, which is a good thing. But on the flip side to that, it has created higher demand in the market, which has been a contributing factor to the inflationary pressures that we've seen.
Yeah, when we call this full employment, like when we're down around 4% or less, isn't that considered kind of like
Yes,
full employment? Everybody that wants a job can pretty much get a job.
absolutely. I think that the Fed's unofficial definition of full employment has been roughly about 4%, and we're slightly under that. We've been at I think it's 3.7% at the last reading.
Oh, good for us.
Yeah,
Meanwhile, speaking of that, we've got some charts here. What are we looking at on this slide?
sure. This is the ratio of job openings to job seekers. So
That's this
we
one on the
have,
left over here.
yes, on the left there. We are at an kind of an odd time right now where there are a lot more job openings than there are job seekers even. So that is what is really truly keeping the unemployment rate low, is that companies um, during the last recession decided that they were not going to lay off as many workers as they have in the past. They had cut so much and gotten so efficient over time that they decided that they needed to hang on to the workers that they had, and everyone in the industrial economy has been trying desperately to find more and more workers. So there are more job openings than there are people to fill those jobs.
Wow, that
So
kills me. It's like every restaurant I look at, you can
yes,
see that in the day to day. But every
so true.
restaurant we look at, they're hiring, they need help. I was traveling recently. The hotel industry needs help. It seems like everybody needs help out there. Meanwhile, we now have consumer confidence. So this is a measure, I think, Jeremy, correct me if I'm wrong. This is a measure of saying, hey, how confident are people in the economy? Is that right?
That's absolutely correct. The University of Michigan does a economy-wide study that they publish, and they take readings every month on the confidence in the consumer market. They survey consumers across the country and basically just ask them how confident are they in their financial future. So this chart just shows the trend of that measure over time. And you can see that the average here is roughly 85. And we've been trending down ever since COVID started in February of 2020. You can see that it has dropped fairly precipitously to points that we really haven't seen since the beginning of the 1980s.
Yeah, what's kind of
And
what's kind of
that is where we.
interesting. I was going to say, you were telling me what's interesting on this chart. Sorry to interrupt, but you were saying the interesting part is this chart is like one of the a wonder in many ways a wonderful contra indicator of markets, meaning that when consumer confidence is high, it's normally a bad sign for markets, but when it's really low, it's a good sign, right?
Right. The stock market tends to be a leading indicator, and consumer confidence tends to be a lagging indicator. So as the consumers become less and less confident, that's when the markets tend to start looking forward to a recovery. And as you can see, each time this measure bottoms, the 12-month forward S&P 500 returns have been positive, double digits each and every time. So it's possible that the stock market could rebound from here. Possible, but certainly not a certainty by any stretch.
No, there are no guarantees with the markets, but I'm
None.
looking at this and I'm thinking, like May 1980, that one look at these positive, what is this? The next 12 months, it made 20%. And that's what all these
Right.
numbers mean, right?
That is
Holy
correct. Yes.
smokes. Yeah. So I'm going to say that, and this bottom we hit right here towards the end of 2022, I mean, that's like a 40. It hasn't been that low. That's low. That's the lowest it's been since 1970, over 50 years, the lowest it's ever been.
Right.
So that bodes well for us, right? So now we're going to move in. Whoops, let's make sure I went the right way. I did. Now we're going to take a look at the price of oil. What's going on? Because this affects the gas pump, doesn't it?
It absolutely does. Obviously, the oil prices are a direct contributor to what we pay at the pump for our gasoline in our cars. And oil prices have been rising very dramatically since COVID. You can see that they dropped down to a very low level in April of 2020, and they rose in 2021 and 2022 to over
I think
$100 a barrel.
we're losing. Jeremy, hold on. I'm going to have you repeat that. You said they've dropped down to.
Oh, I'm sorry. Yes, they dropped down during the height of COVID to very low levels, and they right after that started to rocket higher. And in 2021 and 2022, they were over $100 per barrel. It has traded off somewhat since then. As you know, there have been a number of different factors that have contributed to that, but still, we're at a fairly elevated level for crude oil prices, which it has been contributing to the higher prices at the pump.
Yeah. Now, as I understand it, too, one of the things we need to look at is China is starting to get their economy rolling again. Now they're coming off of their COVID, their zero COVID policy, whatever they call it. So that's going to be a demand on the system, which may have prices rising here. But you can also see on the other side when there's recession, like look, the crash of 2008, you saw that went from 145 all the way down to 30, almost 34. That's a huge drop. In COVID, it crashed and burned, right? Real quickly. So when the economy goes into recession, that can really dump the price of oil down quickly. But at the same time, it sounds like we've got some conflicting, if there's recession, that drives the price down, but with China coming on board, that would drive the price up. So probably with oil, I'm guessing you're expecting to see a lot of this volatility continue. Is that correct?
Absolutely. Yeah. And another factor is the continued conflict in Ukraine that has reduced the supply as well. So that's another thing to throw in the mix.
Yeah, so we'll see what happens there. Meanwhile, as we keep moving along here, if I can forward a slide, there we go. Now we've got CPI, which is inflation.
Yes, and this is what the Federal Reserve has been concerned about for the past couple of years. Throughout 2022, they raised their benchmark interest rate 7 times. At very high levels at each meeting, in fact, to try and combat this inflationary pressure.
These are numbers, by the way, that we're seeing right now. We haven't seen this in 40 years, not since the early 80s.
Early 80s, exactly. It is creating difficulties for the U.S. consumer for sure, which we
Yeah, and
touched on earlier.
yeah, in a lot of ways. And these are our expectations, right? This is what we're thinking, where we think inflation's going. So based on what I'm seeing here, Jeremy, it looks like my interpretation of this is that the Fed, I know they want to have 2% as kind of their benchmark, right? They'd like to see
That's
about
correct.
2% inflation. It
Hmm.
looks like they're expecting inflation to remain elevated for, at least the next few years. Is that, or next, not few years, the next couple of years. Is that fair to say?
Yes, exactly. This particular chart shows the year ahead inflation expectations, and this is a function of the bond markets. So overall, the expectation is for a slight moderation over the next year in inflation. I think the latest reading for inflation came out today at 6.5% year over year. So the market's expecting a moderation from that 6.5% to maybe around 5 over the next
Okay.
year.
Unfortunately, the Fed has not been very good at predicting these numbers, have they?
They certainly have not.
No. And we've got, now this one is kind of interesting. We've all seen the impact of rising interest rates on mortgages. And here we're seeing that mortgage rates have just shot through the roof, right?
Yeah, 2022 was a very difficult year for the housing market overall, and that's largely driven by the fact that mortgage rates have shot through the roof. We were at historic lows of around 3% for a fixed 30-year mortgage. Now you've seen them as high as 7% in 2022, and that raises the monthly payment
Right. That's
dramatically
actually
for
our
your
next,
average
that's our
house.
next chart, right? Our
Yeah,
affordability. So this means that right now houses, the affordability index, meaning you, and this is a measure of what the general, your income people are making compared to a house payment for like your average
correct.
house, right?
Exactly.
Again,
And
levels we haven't seen since what, the
since
mid 80s.
40 years or so, yeah, exactly.
Man, so this is, I want to go back to this for a minute. I think you were telling me that the way that CPI or the inflation index is calculated,
Hmm.
they haven't really included all these increasing mortgage payments in there yet, correct?
That
That's
is
just
correct.
now coming into the number.
Right. The run up that we had in housing prices over the past year and a half to 2 years is just feeding through into the CPI measure this year in 2022. It's largely a function of the way that the Fed calculates CPI. It includes what's called owner equivalent rent. So it's what people think that they could rent their homes for. So it is
Okay.
a lagging indicator of, call it
Yeah,
roughly
basically, I
12
mean,
months.
CPI is going to stay high for a little while, right?
Exactly. And then it
Housing
should
is on,
moderate.
and housing is now unaffordable.
Yeah, very.
Duh. Yeah. You know what? The house prices have gone up. Interest rates have gone up. Of course, it's more unaffordable, but you know what? This is leading to, like, the housing market has come to a standstill. It went from hot as could be to now. I mean, almost nobody's got their houses on the market because can't even sell them
Right.
anyway. So why bother?
Right.
Uh,
Exactly.
Here's consumer spending. We looked at this earlier. This is basically leading the 2/3
Hmm.
of the economy is consumer spending. I think the one takeaway in this, on all of these, is that essentially people are at a point where they were having excess savings during COVID because they couldn't do anything. Now now we're coming out of COVID. They can do things, so they're basically spending a lot of money that they have saved up, right?
That's correct. And we're at the point where we are no longer saving any money. We are spending the savings that we did have through COVID. So you're starting to see like credit card balances rise pretty
Right.
dramatically.
And this goes back to what you talked about earlier: inflation, consumer spending. We're being more frugal. This chart would represent, or this data here would represent some
Hmm.
headwinds, I think, meaning it's looking like
Definitely.
we can't continue that pace. We're gonna have to slow down a bit. Consumer spending slows down, the economy slows down. That leads towards recession, potentially. And then you have how our government spends money in here. In a shocking development, Jeremy, it looks like our government is spending more money each year.
They are very, very good at spending money. That is for sure. And we are continuing to spend money. And the problem, though, is that we have done it to the point where the federal government no longer has much in the way of discretionary spending ability. They're spending it, they're spending basically the entire tax revenue on Social Security, Medicare, defense spending, and the interest on the debt. So
Yeah.
there's not a whole lot else that they can spend the money on.
The one takeaway that I have from this slide too is, because this is information we've known for some time, but
Right.
if you look at this bottom right-hand chart here, World War II, you saw that government spending, obviously because World War II went up over 100% of GDP. And then it came down. Now, why did it come down? Because taxes were increased. Taxes, because of World War II, were the highest tax bracket was 94%. And it was over 70% for years. And
Yeah.
now taxes are much lower than that. But notice where we are. We've got in 2022, we're about to break 100% and projected here over the next 10 years, it's going to go over 100, basically World War II levels, which means tax rates are almost certainly going to be increasing dramatically in the future. It's something we got to watch out for. By the way, this is just a quick chart. I actually dropped this chart. See, Jeremy did all these charts, you guys. He's so helpful. Me, I throw in one or two. This is one I threw in. It basically goes back to your point, Jeremy, where you're saying, most of our government spending is based on non-discretionary or mandatory spending. And right here, Social Security and major health care. You know what the major health programs are, folks? It's Medicare, Medicaid. That's what it is. So Social Security and Medicare basically cover 70% of all government spending. And then you add in interest on the debt, defense spending. It's like these guys, they're as should come to no surprise, our government is not very good at managing money. Here we have the interest rates. So let's kind of shift over to interest rates. So here you referenced this earlier, Jeremy. This is the Fed fund. We were close to 0% interest rates. And this year, look at these jumps. I mean, holy smokes. They went from almost nothing to 4.5% in less than a year.
That's right. And we're expecting more interest rates coming over the next few Fed meetings. The question is still open whether they raise a quarter of a point or a half a point, but still
That's this number right here. That's this one right here in 2023.
Yeah,
right?
They have telegraphed their expectation that they are going to end up at a federal funds rate over 5% and likely keep it there for an extended period of time in order to try and fight inflation.
Yeah, I think that if they could keep it there for longer term, that would make them happy, because if it helps with inflation, number one, that would be terrific. But also, if they can keep it there when there is recession, then that gives them kind of dry powder where they can always reducing interest rates helps with recessions, right?
Exactly.
And that was the short term. Now here's our long term look. And here we see the late 70s, early 80s being, well, let's just say really, really high inflation, high interest rates, long period of them dropping down. We kind of came up, but then dropping down again. What do we notice on this chart? What does this chart tell us, Jeremy?
Well, over the longer time period, we are nowhere close to historic highs. We are actually still below historical averages. So there is potential for interest rates to rise significantly higher from here. We are likely not going to see a period that is favorable for bonds going forward, right? If you were in bonds, in long-term bonds in the mid 70s, let's say mid to late 70s, it was a tough ride. So the longer term bonds could potentially have some difficulties as interest rates rise.
We want to be thoughtful of that. I know you've got a yield curve later on that we're going to look at and talk some more about that. This is the Fed balance sheet. And by the way, I told Jeremy, it's like, I don't even know what the heck this means. And basically, I'll just summarize this one. I think what you told me about this, Jeremy, and tell me if I'm repeating this in a correct way. The important part of this sheet is the trend line that's happening here going forward. And that is the Fed is mostly looking at reducing their treasury holdings or selling treasuries. By doing that, then that puts essentially that should keep treasury prices low, which essentially says that also the opposite is that would mean treasury yields should remain a little higher. Is that what am I reading that correctly? Did I understand this correctly?
You got that exactly right. Yes.
There you go. And so that when we get to the yield curve, that'll be important. Now here we have money supply.
Yeah.
And
So the money supply is an interesting chart here. It has grown fairly modestly from 2012 through 2020. And then all of a sudden, during COVID, it just rose very dramatically. And that was a result of all of the fiscal stimulus from the federal government that, stimulus checks that the government was mailing out to people. It just got money flowing through the economy at a much more rapid rate, which has been a key to inflationary pressures as well.
Yeah, in another shocking development, we went from, let's see, before COVID, we're at call it 15 trillion, right? I think I'm billion, so that's trillion. We're at 15 trillion and then went up to 22 trillion. So, yeah, oh my goodness, more money floating around out there, and we get inflation. How surprising. But it does look like they're starting to, and that might be part of this chart here. They're trying to reduce things in the balance sheet, which should also work its way through the money supply and kind of reduce that a bit as well, right?
That's exactly right.
And this brings up our yield curve. What does the yield curve tell us? What are we looking at here, Jeremy?
Well, a normal yield curve would be more like this bottom curve right here.
The black one, the black line right here.
The black line at the bottom, exactly. You want to see shorter term interest rates being lower and longer term interest rates being higher, right? Because you don't want to tie up your money for long term.
Yeah, this end of 2021. So,
right.
So the idea is, hey, if you've got my money for a couple months, you don't have to pay me as much as if you've got my money, say, for 20 years.
Exactly right.
Right.
But if you look at the top curve in blue, it has changed shape very dramatically. And you see that the shorter terms in this chart, the 3-month and the 1 year, are higher than the longer term.
That's
rates.
backwards.
That is completely backwards, and that historically has been a very good indicator of potential recessions coming forward.
Yeah, whenever you have short-term rates higher than long-term rates, I think every recession we've had has had a yield curve that looks like this before it. But not every time that a yield curve has been, it's called inverted is what that means.
Right.
Not every time. This is not a guarantee that recession is coming, but if we have a recession, this always happened before. This also is why when we're managing money for client portfolios, the only fixed income we hold is short term right now. Like we don't want to hold any, like 2 years is about the furthest we go out right now, for a couple reasons. One, that's where all the yield is. But second, that also protects us against interest rate increases that we know are still coming from the Fed, right?
Exactly right.
Yeah. Meanwhile, we've got this forward PE ratio. Right. So this is kind of the last chart that you gave me, pretty much. What are we looking at here? This looks very fancy to me.
Oh, well, this just shows that it's basically a valuation chart of the S&P 500. It's looking at the price of the index relative to the expected earnings that all 500 companies will provide throughout the next year.
Okay, so it says based upon what the company is earning, here is the price. So if I were to look at this at December 31 at the very end of the chart, 16.65 times, it looks like that's pretty close to our average, right?
It's basically right on top of the 25-year average. So even though the S&P 500 was down, what was it, like 18% for the year, it's still not quote unquote cheap. Right.
Okay, we would argue that it is now fairly valued. So,
exactly.
So back in like 19 and 20, when it was way above the higher green horizontal line, we would
Mhm.
say the market is overvalued.
Yes.
Whereas maybe if you go back to 2008, you could see it's well below the bottom green dotted line. So the market would be undervalued. So what this is just trying to say is it's a measure to say, historically speaking, is the market fairly valued, overvalued, undervalued? Where is it? Right now, as of the end of the year, thanks to the market getting crushed, it's now about where it should be.
That's right.
However, what were you telling me? You said, but Mike, here's the problem. This is assuming that there's an assumption here on what earnings will be over the next 12 months. Is that right?
Exactly. And if we do have a slowdown in consumer spending and we do end up tipping into a recession, that earnings number could come down potentially by quite a lot. And if that's the case, then the PE ratio would move up, right? So the market would get more expensive, more overvalued just by a function of having less earnings.
Okay,
overall.
basically what I'm hearing you say is if earnings go down, this chart's
Mhm.
lying to us. And if earnings go down, because these are just expected earnings right now, if earnings
Correct.
go down, then quite frankly, this line should not be in this middle dotted area. It should be higher, which means
Exactly
basically
right.
there's room for the markets to drop. That's what I'm hearing you say,
Potentially.
right?
Absolutely.
All right, couple last charts, and then we're going to wrap this up with some overall thoughts. We have this is the Warren Buffett indicator. He compares the value of the stock market to GDP. What I really want, we're still above historical trend on this, meaning that the market, as far as he's concerned, is still overvalued by one standard deviation. And here, I want to show you this, beginning of 2000, the market was over 2 standard deviations. And basically what that meant, the market was so overvalued that the next 10 years, it actually lost money. Now, I had good years and bad years during that period of time, but from the point on that chart to a point 10 years later, at the end of 2010, the stock market lost money. Now, at the beginning of 2022, guess what? We're in the same place. Does that mean that from 2022 to 2032, that 10-year period, will the market lose money over that 10 years like it did in the previous 2009 period? No, it's not guaranteed, but it is huge danger. And here we saw 2022, the markets were spanked for that, overvaluation. What's interesting is if you look back at 2000, the markets went down 3 years in a row. They were down 2000, 2001, 2002. Will the same thing occur here? We obviously don't know. We certainly hope not. The other chart from the Buffett indicator, he also likes to look at how the market compares to treasury bonds. And when you have a big gap like we do now from where the market valuations are to bond rates, again, normally not a very good time going forward. One would argue that markets are overvalued there. So let's talk a little bit about that. I'm going to stop sharing the screen here for a minute, Jeremy, just so as we wrap up, we can kind of talk a little bit about what you and I see going forward for 2023. It sounds like we've got some good things. Like I love the consumer sentiment chart. Sounds like consumer sentiment is they're really, really good at picking the wrong time to be pessimistic. Right.
Yeah,
They're
that's
really good
exactly
at
right.
that. So that sounds like a tailwind, but it looks like we've got a lot of headwinds too.
Yeah, absolutely. There's potentially a lot of volatility coming, with continuation of inflation and the downward pressure that puts on the ability of consumers to spend.
Yeah. So we've
It,
got headwinds, tailwinds.
yeah,
Who knows? Inflation's still up there. Interest rates still likely going to be increased. So what are we seeing here? Like if you had to give me a best guess for 2023, do you think, 12 months at the end of the year, it sounds like you're expecting a lot of volatility, or that means ups and downs, good months, bad months.
right.
When all is said and done at the end of the year, you think we'll be up? Do you think we'll be down? If you had to put a percentage on it, what's a guess? Give me your guess.
I it is tough to benchmark what the stock market might do over the next year. And given that, I would start to be thinking a lot more defensively about positioning. You want to potentially put more into, safer dividend type stocks and things
Mhm.
like that are
Well,
paying cash flows.
yeah, that's what we've done with our portfolio, right? We've got
Exactly.
right now 55% of the money is in short-term bonds, that 1 and 2 year bond position that we looked at on the yield curve. And the 45% that's in markets is overwhelmingly in like utilities and dividend paying stocks, the types of stocks that hold their own much better in times like this. And but sounds like though you're not very comfortable putting forth much of a prediction, huh? Your crystal ball is cloudy. Is that what
The
I'm hearing?
crystal ball is looking very cloudy this year. There, like you said, there's a lot of tailwinds, but a lot of headwinds as well. So it could go either way.
Okay, as we wrap up, let's have a little fun. What is your pick an asset class? What is going to be your best performing asset class of 2023? Just pick one.
Oh,
We'll
wow.
have fun. We might even look back and see if we were brilliant or morons.
Yeah, no, just picking one out of the hat. I would think that commodities continue to do well in an inflationary environment with interest rates going up. You want to have more in the way of real assets that you can actually touch. That was the asset class that worked very well during the late 70s, early 80s during that inflationary period. So just taking a wild guess and
More
I
of
think
that, maybe.
more of that maybe, yes.
Okay. Well, I'm going to go the opposite direction, just for fun. And I'm going to, you're talking about real solid stuff is going to be best performer. I'm going to go on the other end of the spectrum and I'm just going to have a little fun and say, go Bitcoin.
Yeah.
I'll go with Bitcoin because I don't know why.
You have at it.
It's been beaten down so bad. Maybe this will be the year. Anyway, there you go.
Maybe so.
And Bitcoin may go to zero. Who knows?
Who
All right.
knows?
That's our message for the quarter. Hope you enjoyed it. And we'll make sure to get this out. If you have any questions, you're always welcome to give us a shout. So we will talk to you again soon.